Most investors focus on profit. They check the bottom line, see a big number, and think the company is winning. They see earnings per share growing and assume everything is fine. But as a chartered accountant, I look at something else entirely. Because while profit is an opinion, cash is a physical fact. You can't pay your employees with earnings, you pay them with cash. Today, I'm going to show you why profitable companies go bankrupt every single day, and the one warning sign in the cash flow statement that you're probably missing. By the end of this masterclass, you'll never look at a financial statement the same way again. We're going to bridge the gap between accounting and reality. Let's dive into Act 1. To understand the illusion, we have to understand accrual accounting. It's the global standard for modern business, governed by complex rules like GAAP and IFRS. In accrual accounting, you record revenue when the sale happens, when the service is performed or the product is shipped, not when the money actually hits the bank account. Imagine selling $1 million contract today. You book that million immediately. Your profit looks amazing. But if your customer has 90-day payment terms, that money is just a promise. You have paper wealth. But if your rent is due tomorrow or your suppliers need payment today, that $1 million in revenue is completely useless to you. You are cash poor. This is the gap where companies die. They grow too fast, book massive profits to please Wall Street, and run out of physical cash to keep the lights on. It's called growing broke. They are forced to take on debt just to fund the growth they've already reported as profit. It's a dangerous cycle that eventually leads to a liquidity crisis. This leads us to Act 2. To find the truth, you must look at the cash flow statement. It's the most honest document in finance, divided into 3 critical sections. First, operating activities. This is the heart of the business. It tells you if the core operation, selling widgets or services, is actually generating cash from customers. We start with net income and add back non-cash expenses like depreciation. If this cash from operations is consistently lower than profit, that company has a quality of earnings problem. Second, investing activities. This shows you where the company is putting its money for the future, buying equipment, upgrading software, or acquiring other businesses. Healthy companies invest in themselves. This is where you see CapEx. But be careful, if they're selling off assets just to pay the bills, you'll see a positive number here. That's a red flag. Finally, financing activities. This tracks the money moving between the company and its owners or lenders. This is how the company is funded, through debt or equity. If a company is profitable but constantly borrowing money in the financing section to cover negative operating cash flow, they are effectively using debt to mask a failing business. When you subtract that CapEx from operating cash flow, you get the holy grail of investing: free cash flow. This is the cash actually available to reward shareholders. Companies with high free cash flow can weather any storm. They don't need the banks, and they don't need to issue new stock. They are the ultimate compounding machines. Now let's look at Act 3, a real-world case study. Let's call them Global Logistics Corp. 10 years ago, they were the darlings of the stock market. For 5 straight years, their net income grew by 25% annually. Analysts were issuing strong buy ratings. To the average investor, they looked like a safe bet for a retirement portfolio. Profit was soaring. They were booking massive revenue from long-term contracts with international partners in emerging markets. On paper, they were more profitable than their competitors. But as an accountant, I saw the rot early. If you looked at their operating cash flow, it was actually declining while profit went up. The divergence was massive. This is the classic trap. The problem? Those international partners weren't actually paying. The company was booking revenue on contracts where they hadn't seen a dime of cash. Accounts receivable was ballooning. To keep the stock price high, they kept paying dividends. But since they had no cash from operations, they were borrowing from banks to pay those dividends. They were funding a lie with debt. The collapse was inevitable. It happened when a credit crunch hit and the banks stopped lending. Suddenly, Global Logistics couldn't cover their payroll. They had $500 million in profit, but zero cash. The company filed for bankruptcy within weeks. Investors lost everything because they were blinded by the profit opinion and ignored the cash fact. It happens more often than you think. This brings us to our final act. How do you protect yourself from the next Global Logistics? How do you think like an accountant before you invest like an investor? Here is your 3-step checklist. Step 1, the divergence test. Compare net income to operating cash flow over a 5-year period. In a healthy company, they should trend together. If profit is rising and cash is falling, run. A 1-year gap might be timing. A 3-year gap is a structural problem. It means the company is either aggressive with their accounting or they have a fundamentally broken business model. Step 2. Check the growth of accounts receivable. If AR is growing significantly faster than revenue, the company is effectively giving away its product for free and booking the sale. Check the days sales outstanding. If it's taking longer and longer for the company to get paid, that's a sign of a weakening customer base or desperate sales tactics to hit quarterly targets. Step 3. Identify the debt dividend trap. Look at the financing section. Is the company taking on new debt while simultaneously paying out dividends or buying back shares? That is financial engineering, not real growth. It's a trick to keep the stock price up while the underlying cash position weakens. It's a house of cards that always collapses. Investing isn't about following the crowd or chasing the latest hype. It's about understanding the evidence, and the evidence is always found in the movement of cash. Cash flow is the truth. By looking at the cash flow statement, you are gaining a competitive edge that most retail investors completely ignore. You are seeing the risks before they become catastrophes. If you understand this one concept, you are already ahead of 90% of the market. You are learning to think like an investor and an accountant. You are building wealth on a foundation of fact. I'm the Accountant Investor. If you found this 8-minute masterclass valuable, subscribe for more evidence-based investing insights. Let me know in the comments, what's one company you're analyzing right now? This content is for educational purposes only and should not be considered financial advice. All investing involves risk. Past performance is not indicative of future results. Always do your own due diligence before investing your hard-earned money. Learn investing through the eyes of an accountant. I'll see you in the next deep dive. Stay logical, stay evidenced, and keep building your wealth.